Hi, what we're going to talk about now is another problem that arises with the recognition of revenue, and that is when you have more than one good or service being purchased in a single transaction. In these circumstances, you need to allocate the transaction price between the separate goods and services, and this is done on the basis of the relative value of the standalone products. Let's think about this in relation to a simple example. We're focusing on a telephone service provider, Telstra, and it sells to its customer a mobile phone, a good, with a 1-year capped service contract for $2,000 payable in advance. So what we have here are two goods or services. Now that wouldn't be a problem if they were both sold on the basis of standalone prices. But the standalone price for the phone is $500 and the standalone price for the service contract is $2,000. So what we're doing here is we're selling products, goods and services, which have a value of $2,500. We're going to sell them for only $2,000. So there's a discount. And we need to have some way of allocating that $2,000 to the phone and to the service. We do this on the basis of the relative values of the standalone prices. So if we focus on the phone, for example, the phone has a standalone price of $500 out of the total standalone prices of $2,500. So what we're saying here effectively is that on a standalone price basis, the phone represents 20% of the combined goods and services being sold. So 20% of $2,000 is $400 gets allocated to the phone. The service represents $2,000 out of $2,500 worth of goods and services being provided if considered on a standalone basis. So that's 80%. So what we need to do is we need to allocate 80% of the revenue, $2,000, to the service. 80% of $2,000 is $1,600. And that determines the amount of revenue that we recognise. $400 for the phone, $1,600 for the service. Let's think about how the accounting works now. On the 1st of July, when the phone is sold, we receive cash of $2,000. That's the easy part. In relation to the phone, that's being provided, and so we can recognise revenue for that immediately. The revenue relating to the phone is $400. However, the service is going to be provided over a 12-month period. So the revenue relating to the service needs to be deferred or recognised as unearned revenue at inception, and that's $1,600. Then, over the next 12 months, assuming we recognise the income monthly, what we'd do is we'd have to recognise some of that unearned revenue every month. So $1,600 equals $133 per month. So every month we would recognise $133 of the previously unearned revenue. And if you think about what's happening to the unearned revenue, you can see that that balance is going to be progressively reduced down to zero over the 12 months of the contract. And that way we recognise the service revenue in 12 separate instalments over the period of the contract. It's pretty straightforward. Thank you.